Okay, folks, good evening. So we're going to talk about how to practice trading institutional order flow using institutional order flow drills. Now, a drill is just basically like a practice session. You're not really trying to make money. So it's important that we know going into this that this is not a system. This is not a technique, okay, for expecting returns on your account. Okay, what you're studying is the effects of engaging specific entry points. Okay, so we're focusing on how to read specific periods in price action when it's probable, so that way when you see it, you can practice it. Now, before I get into it, there's a couple rules we got to simply address right away. You're going to use the smallest leverage possible. Okay, so you're not going to be fixated on how much money the trade is making or losing. It has no bearing on it. What you're looking for is how far the market moves away from these price points and how fast it responds to it. So what we're looking for is specific signatures by the institutions based on a specific criteria. And I made this one very, very simple. You're familiar with it. It's nothing new, but I'm giving you a protocol to follow every single time you sit down in front of the charts. If you have time available, obviously. I mean, if you can't do it, you can't do it. But if you're available, or if you have the ability to record price action intraday, that's the ideal scenario. Okay, it's a worthwhile investment if you can, set your computer up recording price action on a 15-minute time frame. You'll be able to see this as it happens by playing it back, pausing it right when you would see certain things, which we don't have the benefit of doing when we're watching live price action. You have to be able to see what you're looking for and react to it. The number one question I get all the time is how am I able to see these things before they happen? Well, here's the secret. I practiced a lot. I did a lot of what I'm showing you tonight. Okay, so when we say we put the work in, this is one component, one element to how we study price action. This is not the end of all your study. Okay, it's not the secret weapon. It's a way for you all to use your chart time more efficiently. Now, you can make this as in-depth as you possibly ever want it to be, using a 1-minute chart and 5-minute chart. But I'm only going to focus on the 15-minute time frame because you guys watched me trade it today. So, looking at a chart, okay, when we're looking at price action, one of the things that is salient with the reoccurring loser cycle is that you have no idea what you're looking for. You're reacting based on an assumption or chasing price. These drills, well, this specific drill, is aimed at avoiding chasing price. So when we have a session where we're going to be practicing, and I'm actually going to start doing this at least once a week if I can. This week, you just have to use this trade example for this week. But next week, I'll try to sit down and I'll show you what I mean by it by recording every possible scenario. And you'll see, and I'll probably show a loss in the account. That's not the basis of what this is for. What you're trying to do is desensitize yourself from the right or wrong conundrum. So in other words, while we're practicing in a demo, we want the luxury and take advantage of the benefits of not needing to be right. Because when we're wrong with a live account, obviously, most of the time that's going to lead to a loss of funds. So losing money is never fun, but losing while we're practicing can be fun because you're able to learn from those experiences. And you're probably saying, wait a minute, what did you just say? You said losing's fun? In a demo account, while you're learning, it is, because it gives you the flexibility and it gives you the freedom, really, to just engage with price and not worry about the result. Because what we're following is signatures, if there is, as I'll explain in this example tonight, if there's a signature that we're expecting to find in price action, the institution should step in right away and we should see a response immediately. It should not hem and haw. It should not just be lethargic and hang around at that particular level. It should be very aggressive and energetic in the way it wants to move away from it. So we're going to use basically the premise of a buying day, something that's bullish. And obviously, as we go on, I'll give you more details how you can use this. But everything I'm saying here, you would simply just reverse it for when we're bearish. Okay, so if we're assuming that a market understudy, and try not to look around. Obviously, you can see the axis on the right hand side. Right away by the price axis, what this is. It's the British pound. See it up in the upper left hand corner. Just focus on the lipstick here. Okay, I'm trying to show you conceptually without having to sit down and draw up because I don't have that much time today. Today burnt me out. Usually I would create like a slide and draw it all up, but I'm actually using the benefit of today's example in British pound. So it helps me save a lot of time, and hopefully it'll be clear for you. So when we have a condition when we're bullish, now again, suspend the fact that we may not have seen a bullish event this week or this particular day. And I'll go through all those things when we get to it. But assuming that we are bullish on this particular asset or market, this can be anything. By that, I mean it can be a stock, a bond, a forex pair. It could be anything, a commodity, anything that trades. This works. Okay, so what we're looking for is the effects of the draw on liquidity. So we have to have a known area where price should be drawn to. Okay, so in this example, we're assuming that this level of here, and obviously this would be determined based on your analysis, looking through the liquidity profile where we actually sit down and say, okay, where is open float? Open float is the open interest above the current market price and the open interest below the current market price. That is simply said below old lows, above old highs for buy side liquidity and sell side liquidity, and looking for inefficiencies. Okay, so BISI or SIBI. So if you have the understanding that the market should be bullish, this is how I interpret the blank canvas in my mind. This is what it looks like. Now, obviously, you watched me do this today, and I did all over the place. I did the up, the down, and the, how did I do that? Yeah, I bought it, then I sold short, and then I went long on a New York trade. Okay, so I did both directions, and I worked out pretty good precision on all of them. All right, so if we look at price action, and we have it in our mind that we're bullish, the way I interpret price on a blank canvas, okay, in other words, if I'm looking at price and I'm ignoring the candlesticks, okay, I'm ignoring it. Remember, I've said several times, and it confuses a lot of people when I say it on Twitter, I don't trade with candlesticks. I don't trade that. I trade outside of the candlestick. So the methodology and the perception I have of price is not contained in a candle. It's outside of the candle. In other words, it's something that's really not there. And I'll explain that as we get to it. But this is the canvas I had in my mind for today's market activity. I seen this in my mind. And then what I do is I wait for price to create the scenarios that leads to a move from this price down here, which is the opening price. What is the opening price? The opening price at 4. So on AVA trade demo, and incidentally, I'm looking at IC markets because I can't really do what I want to do with you guys for S&P trading, because I want to start doing some short-term and day trades for trading the SPOOS market, kind of like broaden our horizons outside of the scope of just Forex, because I want to be able to prove, obviously, is consistency in every asset class, and eventually we'll work our way into stocks going into the fall. But the idea is we want to see the opening price and a willingness to move away from that on the upside if we're bullish, obviously. But what's it being drawn to? A level of some old high, an old low, something that would draw the price to it in the form of a resistance level. It's the easiest way to say it because most of you here would understand that simply as a new membership member. The idea is we want to be able to see where price is trying to reach for. So where price is right now, that's current market price, and where it should reach to, that's our range. Okay, inside that range, it can be further defined relative to the kill zone. So now we're going to incorporate the New York kill zone. This drill is only to be practiced in the New York session. Now, here's the wonderful thing. While we still only want to focus primarily our studies on the euro dollar and the British pound versus the US dollar relative to mentorship commentary, in between those conditions that I outline in commentary, if there isn't price meeting any of the criteria that I mentioned in the commentary, the weekly videos, what do you do in the meantime? Okay, well, you can open up any pair whatsoever. I don't care. It can be an exotic. It could be another major. Whatever you want to look at and study. Okay, this is how you use your time efficiently. You draw out your kill zone using the New York kill zone and waiting for specific things to unfold. What would that be? Well, if we're bullish, we're expecting movement away from that opening price. So between those two price points here, that's basically our dealing range. We're working within a finite range of price that has yet to unfold. So I'm seeing this in my mind before price trades there. I see it as it should reach up there, and as price more or less is delivered all day long, I'm expecting it to get to that level and sweep above it, because what's above this level, the actual liquidity. Now, it can hit it one time or fall short of it and have a retracement of some sort, and you saw that today in my British pound versus US dollar trade. I didn't freak out when it started to pull away from the level. I knew it was going to go higher, and all it did was pull back down into a bullish order block. The reason why I knew, and you can see the commentary being added as it's happening, I'm not freaking out, I'm not scared, I'm not worried about it. First of all, it's a demo, so I can't lose any money, but nonetheless, the experience factor has been derived by doing what I'm showing you here. So, in your mind, price action works off of this specific model here for this institutional order flow entry price drill. So we're looking for areas where we enter, going long. Everything that's here, just write down everything I'm saying, but reverse everything. So if we're bearish, everything I'm saying for bearishness, you would just do the opposite that's being shown here. So I'm trying to save some time and also give you some homework. So if price were to meander and move up and create a scenario where it gave us a move like this. Now, I'm just speaking hypothetically, obviously, because this is not going to look anything like what we saw today on the British pound. But if we're looking at it and we're expecting some bullishness, and the underlying price move for the day so far was here, and we see this up here, my mind is, okay, we're inside of New York. We've had a run ahead of New York's open. So this whole price run here, it's probably going to be met with some retracement, and it's going to want to seek a measure of liquidity below current market price. And at the time, the current market price would be here, hypothetically. So inside of this low, and where price is now at this moment here, hypothetically, This is the known range, okay, because we had a nice little swing here and it rolled up. My mind immediately goes inside of this range here, and I'm looking for inefficiency. I'm looking for periods of where there's one candle that just doesn't have any rebalancing. In other words, it's just one little single candle, and it can be as small as 3 or 2 pips, and that's going to be enough for me. And I'm going to anticipate price dropping down inside of the New York kill zone to fill in some measurable inefficiency. Now, it could be, like I said, as small as 2 or 3 pips or as much as 10. But price should come down right inside there. What you're going to do, and this is how you practice it, the assumption is, using this drill, and again, do not be afraid of being wrong. If you go into this with the expectation of, okay, I'm going to be looking for trades, and I'm going to use a lot of leverage, and I'm going to do this, and I'm going to do that, and it's all about training myself to see paper money, you're doing it wrong. Don't do that. You want to use the smallest leverage, because we're not having to worry about any kind of partial profit taking, no scaling out, none of that stuff, okay? What we put on is what we take off. Okay, so what you're going to do is you're going to see when price drops down into that inefficiency, you're going to look at the inefficiency and split it right in half. Right in half. Whatever that inefficiency is, okay, or fair value gap, whatever that is, divide it in half. That price in between the high and the low, whatever would create that fair value gap or that liquidity pool, when price creates that vacuum of only buy-side delivery and no sell-side delivery, that buy-side imbalance, sell-side inefficiency, we're going to split that right in half, and that's going to give our target price. Okay? Then you're going to add whatever your spread is, usually for that currency pair. If it's not a currency pair and it's like it's a futures contract, then you don't really have to worry about that. But I still like to fluff it up a little bit and go to the nearest 5 or 0 level in a futures contract, if it can be done. So if it was a bond market, I would just go 2 ticks. So if I see a fair value gap, I'll split it in half, add 2 ticks to that, and that's where my entry is going to be. Okay, now you can do 2 ways practicing this drill. You can use limit orders, especially if you're up here and there's enough range, because in a demo, obviously, we have to have a certain measure of pips before it'll let you put the limit order in. Or do it as I do it most of the time when I'm doing my trades. I'm showing you that I'm aware of what's going on, and I'm clicking the market entry immediately as it hits the price I'm watching for. Sometimes you see I'm nailing the actual high and the actual low of that candle and of the move, or that session high or that session low, or the daily high or the daily low, or very, very close to it, because I know what I'm looking for. So it looks like magic. It literally looks like, there's no way that I should be able to know this stuff. But believe me, it took years of practice doing it. But I practiced like this, and this is what got me there. So you split the range of the gap in half. That middle price, okay, that is exactly what you add your spread to. That's going to be what the level you want to see traded to for a limit order. You do not need to do that if you're going to do it as a market order. You'll simply wait for price to come down and touch what would be seen as that middle level. Now, you're going to find many times, if you're waiting with your finger on the trigger of the entry button and you're wanting to buy it, the fact that you see it traded at middle price, and by the time your brain sees it, it identifies that that's what you're supposed to be doing, because there's a time delay. Okay, it's like when you get in a car accident or get ready to get into a car accident, your brain sees the car or obstacle in front of you. You see it, your brain comprehends it and processes it. Okay, I need to stop. Then your brain sends a signal down to your leg, to your foot. Then your foot comes off the acceleration pedal and goes onto the brake. All of that is not happening immediately. It's happening very quickly. Our brains are processing it very fast. But the benefit of waiting for it to touch the middle point here is, even if it just touches the middle point and starts to go up, many times you'll still be inside that fair value gap or that inefficiency. The ideal scenario is, and this is how I've grown accustomed to doing it, many times I nail the low, is as it touches that middle point of the fair value gap, by the time my brain sees it and I process it and I hit the button, the price may actually skip down to the lower end of the fair value gap and give me a better fill. And that's the benefit of doing these drills, because you're conditioning yourself and desensitizing yourself to waiting for something to happen that you know that you're looking for a specific thing to unfold. You're not guessing. You're not staring at charts thinking, well, what am I looking for? You know exactly what you're looking for. When I was on Baby Pips, I sold the narrative that if I could sit in price all day long, I know what I'm looking for. The 90% club, okay, out here, they don't know what they're looking for. And that's the reason why they look at indicators, because the indicator is telling them what to look for, because they don't know what to look for in price action. That's what makes retail minded and retail thinking so myopic, and it's backwards. You're looking at the very thing that's going to distract you from what you should be watching. This is price. So when we look at price and we see this, what we're doing is saying, okay, I have not met the draw on liquidity. I am inside of a period of time where it should react. It should create a retracement and then a follow through on the upside. You know what you're looking for a timing condition. Okay, so you have time. You have a specific price level you're looking for. So now what do you have? You have an entry. It's a qualified entry. Why is it a qualified entry now? And this is for your notes. If you're not writing this stuff down, you're literally wasting your time. You're not going to remember this. Okay, you need to write it down and review it. Every Saturday, sit down and say, okay, I'm going to do this. I'm going to do this. I'm going to practice this. I'm going to look for this. And if you just listen to me, it's not going to sit in. You need to write it down, put it in a step-by-step. This is what you're looking for. But a qualified entry is where you have a draw on liquidity. So that's where the market should go to. There's your bias. Your entry price point, okay, or your entry level, specific. It's finite. It's not ambiguous. It's not a supply and demand zone where, you know, who the heck knows where you're going to get in there. What's the criteria for that? And you know when you're going to anticipate it happening. So you have a price, a time, and a target. So what do you do for a stop loss? How do you manage that risk? Well, you can open the stop up below this swing low here and just let it ride. Put the order in, let it hit. Do not concern yourself with, well, what's the R model here? What's my R multiple? Okay, do I have enough here that that's not, you're looking to be trading. That's not what this is. You're teaching yourself institutional order flow and the importance of cherry picking points of liquidity that the institutions are going to be dogpiling on. That's what we're looking for. This drill's specific motivation is for you to get over that hump of, what am I looking for when I look at price? I don't know what I'm supposed to look for, because what I just gave you here is a complete system. There's nothing else you need. There's literally nothing else. But I know you want to learn everything else, and that's fine, and I want to teach you. But you need to be using your time efficiently and know what you're looking for. So now, with that in mind, when price hits that level, what are we doing at that moment? We're watching how much time takes place. You want to see when it hits it, you want to note the time. What time is it when it occurs? When it hits that price level, there's your time. You want to write that down. It's very, very important. You want to write that down. Then you want to sit and wait and see how much time it takes to until it responds, in the sense that you wanted to see it go higher. Okay, great. Does it show a willingness to do so? And if it does, great. Once the high here gets taken out, your stop needs to come up to 50%. Now again, if you're not writing this down, you're blowing it. You want to take the range between the low and this low here. Once this high is taken out, okay, once this high right here is broken, you want to move the stop loss from this low to 50% of the range between here and here. Now why? Because price could one more time drop down. It can drop one more time into maybe the order block that exists here now. because there may be an order block that forms. We have a reaction in here. We can come back right back in here and go real deep in the order block, and the spread might get you. Your broker has the ability at this moment here to widen the spread and take you out. That's why sometimes when you all say, hey, my chart didn't go down to that low or that high. And many times if you're in a trade, you're going to see that it does go down there. It takes you out for that reason. By having our stop loss move from this low to only 50%, it keeps us under the fair value gap. Okay, it keeps me under the fair value gap. Look at the example I showed on Twitter today, going long on the New York session for GBP USD. That cable position, the stop, was underneath the fair value gap. Okay, that's what I was showing you there. Because of that void, okay, this is how I put it on the Twitter recording, because I knew I was going to share it publicly. I didn't want to have any kind of mentorship level details in it. I just kept it to, what you saw. But we don't want to be prematurely stopped out. Once the high is taken out, then you reduce the risk. You do not jam it up to your entry or go 1 point above the entry. You don't want to do anything like that. You want to keep it away and underneath this whole condition. This is the condition that gave you the basis of wanting to go long. It's a fair value gap. Or liquidity void. It's an imbalance. So it was only buying there. Price comes down, gives us an opportunity to rebalance this little area in price action with sell side delivery. And then once it does that, price should be very responsive. And if you look at the video, I actually time exactly when it's supposed to pop up, and it pops up. Now, when you do this drill over and over and over again, every single day, over time, you're going to get really good at it. And you'll start seeing the exact points of entry that you want to have, and your brain will see the chart and say, okay, I see this opportunity. Here's where I think it's going to go to. I can see the draw on liquidity, because 90% of you, once you watch the videos, I talk about how to see where the liquidity pools are or where the market should go. And the perfect example is the equal highs and equal lows. That's why I use that one first when I'm teaching, because it's easy. My little one can see it. He goes, oh yeah, that's where it's going to go to, Dad. It's going to knock out that line. It's going to knock out that line. I don't have a line on my chart, but he interprets that as a line because he's seen me do what? Draw a little horizontal segment above the equal highs or below the equal lows. It's going to break that line, Daddy. There's no line there. But he's been trained to see it as a line being broken. So you need to teach yourself, okay, just like I've taught my son, to understand where the video game of price action, as that's what I talk to him about, and I say, where's it going to go? Show Daddy where it's going to pop up to or pop down to. And he points right to the double highs or the double bottoms. And it's simple. And many times if you keep it very simple like that, and if you have an underlying bias, trading's easy, because I just gave it to you here. You know what you're looking for now, an entry point. And what makes it institutional order flow is because there should be an immediate response to that, and they should not be wasting time before it takes off again to the upside, and it does. So now I've given you a reason to want to be a buyer in your demo trades, how to manage the stop, where the stop should be. Now, what happens if there's no swing low down here? What do you do there? You want to be below any down close candle. Like say this low here to this high here is all one consecutive price swing. And there's really no discernible breaks or retracements in that. Just simply find the biggest, boldest down close candle, and your stop needs to start underneath that, because that's going to many times be an order block. And then maybe this will retrace deeper. It may not respect this. It may trade down to the order block. Okay, and that means you can weather the trade and still have the condition that is the draw on liquidity over here and the entry here. We might get a little bit deeper retracement, but not get stopped out, and then it takes off. Again, you want to see examples of that, and you're going to experience it. And it gives you there's no better way of describing it. It just gives you the experience and knowledge base to draw from when you're watching price action. I've seen millions of things over and over and over again over my 20-some years doing this, and I'm not surprised. Let's not be that far with it, Michael. I'm very infrequently surprised with what goes on in price. Now, what we look at today, I'm going to show you, and because this is starting to get a very long video, so let's go into the price action for British pound. All right, so here's the price action for the British pound. And very quickly, I just want to go over what I mentioned last week. I taught you guys. Whenever there's a gap on Sunday, the normal action is if we gap down, we want to see a whiplash, which is price going back up, filling in the gap. This movement here is whiplash. This run up, filling in the gap, that's what I nicknamed whiplash. It opens down here and boom, it jerks it right back against everyone thinking it's wanting to go lower, usually the retail club. At this moment, it becomes catapult. Catapult is where we sell short after the down opening gap is filled. What do we trade into? An order block. I gave it to you on Twitter. Look at the chart. Price trades down into the order block. And here's the opening price. So here's that opening price if we are long. Now, I'm not suggesting, because believe me, if I would have felt this was going to happen, I would have went long right in here. I didn't see it coming. I was doing payments after I did all the exits on the trade that you saw going short in here. This long here is really a power 3. You have the open, we traded down below it, and rallied up. Now, if this would have been part of a move that was sustained on a daily chart that's been going higher, and it's been clear, which it hasn't been on the daily chart, let's just be clear about that, then I would have been buying down here. I would have been looking for that to happen. But because it's Monday, I did enough damage in my examples, I wasn't watching this. I didn't see it as a buy, but I did cover as it went down in there because it's the order block. It could have bounced up, and I thought it was going to fill in this gap here and then maybe give another sell-off in New York. That's full disclosure. Okay, that's what I was expecting initially. But we saw it tearing through, and then I said, look, when we see that gap, okay, if it's broken on the upside like it does here, well, wait a minute. Now we went up and filled it. We went down, but then we went back through and started moving away from it. That's very, very bullish. Everything I mentioned last week relative to the gap on the example we were looking for in the last week's discussion relative to gaps. If we have a gap that is a gap down and we trade above it, that's extremely, extremely bullish. But I couldn't catch anything in here, so I simply waited for an inefficiency to open up. Inside of the New York kill zone, we see this one big candle run up there. Did this candle get to our draw on liquidity, which is the previous day's high or last Friday's high? No, it didn't. So I'm going to wait for price to drop back down into this inefficiency. I know that institutions are going to want to buy right in here because they know the liquidity resting above here. So IPTA will come down into that and allow those traders to get on board. That's what you watched me do in the video today. As it slammed down, I'm buying it. Now, notice what I'm doing. I'm buying as the market's dropping, even though it's at the high of the day. That's scary, but it's a practice session for you to get used to. It's not too high. Look where it went to today. So if we know that, for instance, the economic calendar, we knew that there's going to be a lot of volatility. Be careful. Don't try to get in here and try to be fancy dance. So we're going to focus on one thing. The condition is bullish because we had that gap traded above. It should have only went up and filled the gap here and then broke down and traded lower. It did, but we were unable to make a lower low here and go lower. It stopped it in its tracks and then they put it on the other direction. Once the gap is taken out, that's significant. We want to be a buyer, but we don't want to chase price. Now, I could have went in here and bought right inside this down close candle. Right when this candle was right at the close, I could have bought right there. That's a close proximity entry. That is an institutional order flow drill. You could do that as well. It doesn't have to be the inefficiency. You can be buying close proximity down close candles inside of the candle and the unrealized objective, the draw on liquidity, which is over here. That would be the basis of your entry. And again, same premise. You want to use a stop below some swing low, or if it's a down close candle with no real distinguished break or retracement, you go below the order block or down close candle. You saw me use the fair value gap or liquidity void here. As it traded down into it, I nailed it. Went long, hemmed around in here a little bit and waited, and then I said, okay, we're going to see it expand on the upside, and then popped up on this candle here, and I said in the video, this is going to be the last down close candle until it runs through Friday's high. there's only one down close candle. The way I did that and what made me know that is inside of this little consolidation of price action. Now, granted, this is like a bull flag. This bull flag had a lot of things going for it because we had the liquidity pool resting over here and the fact that it was not traded to, and it's extremely bullish because we took out the gap and traded above it. And we're inside of a New York kill zone. So relative to time and price, we have a retracement in an existing bullish condition and a target that has not yet been realized. So when price drops down, we're buying a down moving market. That's exactly what institutions and banks do because they have to buy large volume at opposing price movement. In other words, if we're buying, we need to be buying when price is dropping. If we're selling short, we need to be selling short when price is rallying higher. You have to do that. If you want your trades to turn around with the lowest point of drawdown, that's how you do it. It's scary because you don't know what you're doing because you haven't done these types of drills. But close proximity entries using the relative high in here on this down closed candle. Once that candle closed and we opened up here, even when the price rallied up to this point right there, okay, right there, that's still a buy because you're inside of this down closed candle. Later on, that down closed candle could have been traded down into this void or fair value gap could have been just one piece of it, and it could have went down a little bit deeper and traded into the order block, and that still would have been fine. You're going to see examples of it happening like that when you do this. It doesn't mean you're wrong. It just means it's giving you experience by watching price with a specific criteria, a perspective on price that should be very clear to you. And guess what? If it screams against you and stops you out, that it's over. There's nothing else to take from it except for the experience now you have from it. Did you lose any money from it? Yeah, you took whatever it was in the smallest form of leverage, okay, that the demo account can provide for you, and you took no monetary loss. No one saw you take that at losing trade, and you're not looking at it as a trade. So mentally, you have not classified this as a win or loss, or a profit or a monetary loss, or a measurement of aptitude. That's not what this is. Believe me, if you go into that practice session with that in mind, you're really just building toxic thinking. I sat down every single day and looked at price action and looked at price action and looked at price action, and I didn't even engage for months. And then I started practicing this over and over and over again. And you see what my trades look like. I'm getting in at ridiculous levels underneath old lows or at the lows, and I'm getting out above an old high or at the high. I learned how to do that by practicing just like this. Now, you don't want to do this drill once a liquidity pool has been taken here and we run out of time. So over here, this whole move here, this is all attributed to tomorrow's Brexit vote. Okay, you're going to see these types of moves. There's nothing you can do to predict every single move. You just can't do it. So have it in your brain that, again, you're not trying to get every move. You just want to get logical surgical strikes to practice on. Now, over time, when you work with an intraday price action like this, doing these drills, there is no difference between doing it on this 15-minute time frame and if this was all a daily chart. Think about that. Because price is fractal, and what I'm teaching is institutional order flow. If this was a daily chart, and say this was an old daily high back here, and every one of these candles was represented to a one candle for a daily candle or daily bar, this big run up here, retail's going to want to buy that. Well, they retrace. You're not going to buy that. You're going to do the same entry technique here, right in the middle of that fair value gap or liquidity void. You know that there should be buying in there. Well, hello. Now you're a swing trader. Look how much of a move you would have captured if these were all daily ranges. Now you want to look at it another way is say this is a weekly chart. Say every one of these weekly or these candles represent a weekly range. Same thing here. You would drop down in here, you'd be buying, you'd have a stop down below the swing low or below an order block, and you would just let it go. And imagine the amount of pips this would be if, again, these were all weekly ranges. Huge amount of ranges. Now I got your gears turning, haven't I? So, if we can see the benefit of practicing with a logical protocol, a step-by-step, looking for specific criteria, time, price, draw, and liquidity, we know what we're looking for, we know how to define our risk, there's no reason why you can't find your 25 to 30 pips a week now. Because every single day, it gives you one. Some pair with a major against the dollar, every single day gives you one. Every single day. There isn't a single day that does not pass that you cannot find a low resistance liquidity run on in a major. I'm not trying to teach you everyday trading, but once you understand how to do it, you have the freedom to go through a handful of pairs, have a basket of currency pairs, but you don't want to have a basket of currencies when you're developing or learning how to do it, because there's too many things to be chasing and you're distracted by it, because it's very easy to get lulled into thinking,